Let's Talk Money.
Hello and welcome to another edition of Let's Talk Money. I'm your host, Surabhi Upadhyay. Retirement security is not something that the state provides in India. It is in our hands to plan our wealth in such a way that life after 60 remains comfortable and secure. Can the National Pension System, or the NPS, achieve this goal? Yes, you guessed it. Today's show is all about understanding whether NPS is our one-stop solution to securing our retirement period. Many of you have written in with the questions, and we're going to try and answer as many questions as we can over the course of the next 20-odd minutes. So let's get ready. Make sure you listen carefully, take notes if you need to, and let me now introduce my guests on the show. Dhirendra Kumar of Value Research and Rahul Bhagat, CEO at DSP Pension Fund, is right here with me in the studio. And of course, Dhirendra is joining us all the way from the national capital. Gentlemen, great to have you here. Can we have Dhirendra? We have Dhirendra there as well. So great to have both of you in on what is a really, really important subject, because I think there's a lot of chatter around mutual funds and using mutual funds as a tool to secure ourselves. But the NPS, I think, requires a slightly closer look, because it, in some ways, maybe it's a slightly more complex instrument. So I want to start by getting, your first thoughts. Rahul, why should one consider the NPS for retirements when you have things like mutual funds at your disposal?
Yeah, very good question. NPS, and I believe, has all the ingredients which are required for the retirement planning. Though people are using mutual funds for retirement planning, but NPS by far is the best product because it offers a lot of tax benefits. The cost at which is offered is one of the minimal in the industry. You can look at investing in NPS from as low as 9 bips to 3 bips, depending on which is your fund manager. Plus, it offers all the other asset classes and a lot of flexibility to choose whether you want to be active or an auto selection in terms of asset allocation. Given those parameters, I think NPS stands by far the best.
Okay, and we're going to analyze a lot of these things that Rahul just mentioned, the flexibility, the fact that you can choose different asset classes in more detail. But Dhirendra, opening thoughts with you as well. Why NPS?
NPS, there are many advantages, but if I have to prioritize, if I have to say two big things why you should choose NPS, if it is going to be your longest term investment, the low cost is something which cannot be matched by any other investment. And the other is, the tax efficiency. And if you are able to persuade your employer to contribute to the NPS kitty, then this is the only other income which an investor will have in his account, which will be tax-free. Because besides this, only agriculture income is tax-free. So these are two these are two unique benefits: the cost and the tax advantage.
Okay, fair enough. Gentlemen, so let's do one thing. Let's go over the brass tacks first, and then we'll start, comparing the advantages, disadvantages, etc. So people understand what the structure is like. Now, the NPS to begin with, it has two different types of accounts. And then there are rules as to, which ones get the tax benefit and which don't. So, Rahul, why don't you start? Take up the first part of it. Who all can invest in the NPS? And just explain to us this concept of the Tier 1 account and Tier 2 account, and which one is for us.
Yeah. So NPS can be utilized, or any Indian citizen can invest in NPS, age from 18 years to 70 years within that age bracket. Now, NPS offers two types of account, as you said, Tier 1 and Tier 2. Tier 1 is your pension account, and Tier 2 is your investment account. Okay. Tier 1 is the account which gets opened by default when you look at NPS. Tier 2 is a choice whether you want to open that account or not. But if I were to guide or tell people, you should open Tier 2 account as well, because it's free of cost, there's no charges. Tier 1 is where when you save for your retirement, you get all the tax benefits.
So when I'm putting in the money every month in NPS, Tier 1 is where that sum is accumulating, right?
Yes.
And on that, I get the tax benefits.
Tax benefits, and that is your retirement kitty. Tier 2 is basically your investment account where you can invest money, withdraw money at any given point of time. There are no restrictions. Okay. So purely it's an investment account, and Tier 1 is your retirement account.
So Tier 2 has nothing to do with the corpus that you'll get at the end of your retirement, right? For all practical purposes, Tier 1 is the account.
But there's one thing which people don't know.
Okay.
If you have saved enough money in Tier 2, and for some reason you feel that Tier 1 is not going to be sufficient for your retirement, you can transfer funds from Tier 2 to Tier 1.
Oh.
That option is available. So you can do that.
Okay, well, small nuances and lots of them with the NPS that, this is just starting point that we're trying to be aware of. Dhirendra, let's go over tax, because whether we like it or not, I think a lot of investors look at tax as a very important parameter when they're deciding, what to opt in for. And just help us understand taxation both at the contribution stage and at withdrawal, because I believe that at least 60% of that retirement corpus you can withdraw tax-free.
Yeah. So, this is also a clear differentiation as compared to mutual fund. When you invest in a mutual fund, the equity treatment is that all long-term gains is taxed at 10%. In this case, 60% of your money is almost like a mutual fund. You can take it out at your, on special occasion and on retirement, and it's a tax-free withdrawal. All the gains are tax exempt from that point of view. 40% has to be annuitized. So that is a distinct advantage. There is one more thing which comes with NPS, that your employer's contribution to NPS to the extent of 10% of your basic salary is, it can be expensed by the employer, and it is not considered as your income. So that is the exempt income. So the appreciation is exempt. The investment that you make here in NPS to the tune of up to 2 lakh rupees because of ATC, ATCCD and ATC is a deductible expense, is a tax saving deduction available there besides the employer contribution. And also, it is the only EEE to the extent of, it's the only EE vehicle available to investors.
EEE, exempt from tax when you're contributing, when that sum is, accumulating, it's gathering those returns, and exempt when you're going to withdraw as well. The withdrawal is not as straightforward, and I think that's where a lot of questions are coming in. So, gentlemen, allow me to get to our first query. Sumit has sent us this question on Instagram. He's saying, I've invested in Tier 1 NPS. However, now I'm considering to put this money in a small cap mutual fund because of the lock-in periods involved and also the 40% annuity compulsory condition that is there. Please remember my disclaimer. He says I'm a disciplined investor. And it's not like if I put it in a mutual fund, I'll keep withdrawing it. So he's saying, do you think I should switch from NPS to a small cap fund? Dhirendra, now I'm going to come back to this. We were just discussing withdrawals, right? Explain this to us, because not a lot of people might know that when you retire, 60% of the money you get the total accumulation tax-free. That sounds wonderful. But 40% has to be used to compulsorily buy something known as annuity. Explain that to our viewers. And now annuities are taxable. And this, I think, for a lot of people is a bit of a googly.
Annuity is taxable, but you have the income from annuity, because the annuity, the way it works is you put your capital, you invest your, you buy annuity, and it gives you a periodic income. And there are three formats of annuity, three forms of annuity. One is that there's a defined income that you derive from it. It remains constant. Then there is the inflation adjusted, that your income or the return comes down, but it gets adjusted for, or it's a growing income, so to say. And then all annuity comes in two forms. One is that you get your capital back, or you can nominate somebody getting the capital, or no withdrawal of capital. So with that, so the insurance company giving you the annuity, or the annuity issuer is taking your longevity risk. So you have to decide that, and that a lot of people might think that that income is not good enough, or the returns on those are not enough to support your income needs in retirement. But that is only to the extent of 40%. When planning for your retirement, you have to think of different kitty, or different contribution. There could be multiple revenues that you can derive, like the 60% accumulation in your retirement account. You are at liberty to invest or do a periodic withdrawal plan. And who knows, if you still have time, I'm hopeful that PFRDA will consider, because, they have done it partially. They have done it for even for the 60% that you're accumulating, that you can retain it in your NPS account and keep withdrawing from that. You don't have to necessarily take it out, which was the case earlier. Okay. Now, so there is a possibility that, PFRDA might enable something like a systematic withdrawal plan from your investment, and in a measured way. so that you don't have necessarily to need to buy annuity.
Rahul, come in on this. I think this is really the heart of the debate, that the 60% part people love, right? But this whole thing of I compulsorily have to put that money in, give it to a pension manager, then I will get annuity. Also explain how it's calculated. You know, if let's say, my retirement corpus is 5 crores or 1 crores, we can take for the sake of simplicity. 40% gets parked in that annuity. What's the number? How much money do I get at the, at the end of the day? So and is it going to be sufficient, inflation adjusted?
So if it's 1 crore as your corpus, 60 lakhs you can withdraw tax free, 60% you can commute, 40% is which you have to buy minimum pension. You can always buy pension for entire 1 crore, but the regulation says minimum is 40%. Now 40% depending on what interest rate are you retiring. Today the interest rate or annuity rate which you get it closer to 6.5–7%, not beyond that, right? But after 20 years, depending on what the inflation is, maybe if the inflation is lower, interest rates are lower, maybe you get a lower annuity. So it all depends what time you're retiring and what are the interest rates in the economy will impact your annuity rate.
So let me make it even simpler. We go back to the example. If someone is retiring today with a total NPS corpus of, let's say, 1 crore rupees for the sake of simplicity, 60 lakhs the gentleman or lady can simply take home, withdraw it, take home, do whatever they want with the money. Balance 40 lakhs, how do annuities work? And what is the realistic sort of monthly take home or annual take home this person can expect?
So I can easily, if you are 60–65, you can assume safely today to get an annuity of 7%. So 7% of 40 is 2.8 lakh rupees. Right, which is on annual basis, which is not much, to be honest. And people fret a lot about annuity. A small percentage of your portfolio is getting locked in at a fixed rate. I think when you are also planning your retirement, there's no harm in it. Because if you go back sometime, few years back, the interest rates were higher. And people at that point were also cribbing that the annuity rates are lower. But if you see today, if I have got an annuity rate of 10%, it seems so much better than a 7% today. And what I call annuity is fixed deposit for life. Because the interest rates will never change. It's going to remain same for your lifetime. People forget that. And no other product in the industry, no financial product can actually give you the fixed return for that longer duration.
That's an argument. That's a strong one, that it's a fixed interest rate for the rest of your life. So that's a strong case in favor of annuities as well. You know what, we need to take a quick break, but when we come back, we discuss another very important facet of the NPS, the fact that it allows you to move between asset classes, whether it's government debt, whether it's corporate debt or equities. How should you plan your investments? We'll discuss that after the break.
Let's Talk Money.
Welcome back. You're with us on Let's Talk Money, and this week we are completely breaking down and doing a SWOT analysis of the NPS, the National Pension System. So tax is a definite hit. Annuities, yes, but perhaps there's something good about annuities too. We've discussed that. Now let's talk about asset allocation, the fact that NPS allows you to move freely between equity, fixed income, now that could be corporate debt or government debt. We've got a query coming in on this, so let me start with that. Naveen is asking us this question. He's saying NPS gives us the option of switching from a 50-50 mix between equity and debt, going up to 75-25 in favor of equities or vice versa. Does this make it better than mutual funds? What are the pros and cons? Dhirendra, let's take a step back actually and also tell viewers, how this whole asset allocation, how the choices work.
The choice is the maximum that you can have in equity through NPS is 75%, and you have to define it. You have to decide yourself. And otherwise, there is the auto plan, which will, which is linked to your age, and the allocation will be automated. So 75% allocation to equity who still is 10–15 years away from realizing that money or in need of that money is fine. And that is the maximum that is possible there. As compared to that, in mutual fund, you can have 100% investment in equity, or you can choose your vehicle and it could be all equity or whatever you want to. But in case of NPS, if you compare it with what is being touted as or what is being referred as a constraint, I think it is a great advantage, because the real problem of investment in mutual fund is that you are often tempted to pull your money out I think the lock-in or the lack of liquidity, the constraint that you cannot pull your money out is a very desirable enforced restriction. And I think people should embrace it. This is one part of your saving which you should not touch, and you should look at it because and you should always think in terms of what it is meant for. It is not retirement. It is basically dignity and making sure that you are accumulating your savings for future, and so that you're trying to reduce the risk of outliving your savings. And that is a very dreadful possibility which nobody would like to settle with. So with that in mind, I think this liquidity bit and not having and 75% might be a constraint, because I would think that in the initial phases of any investment, when you don't need to do asset allocation, de-risk yourself when you have nothing to de-risk from. But after you have accumulated something meaningful, having 25% allocation to fixed income is very desirable. And this asset allocation and complete, your ability to rebalance it without any tax incidence is one unique feature of NPS. Any other vehicle, if you invest in debt fund, or you invest in an equity fund, and you want to rebalance it every time the 50% into equity or 75% into equity becomes 80%, all the gains will be taxable and you will lose 10% of the gains. Not in case of NPS in tier 1 or tier 2.
Okay. Fair enough. Just quickly, Rahul, come in on this. I mean, a lot of people obviously want to maximize their returns, right? And by perhaps putting it in equity. What do you advise people? Is this auto choice, which automatically changes the allocation depending on your age? Is this the better option, or should you just, park the maximum possible in equity?
See, it depends on whether you understand the markets or you don't. Active fund management is for people who relatively understand the markets better and take the calls depending on the markets and other things. Generally, people who don't understand can take an auto choice and can also still take an aggressive portfolio option, because that auto choice also gives you three options, which is aggressive, moderate, and conservative. Okay. And aggressive is where you have the highest equity.
So up to 75%.
Up to 75%. And that's a good option. You can choose. So depending on whether do you understand the markets or you have a time to look at the markets and change your portfolio, which most of the people, if understand, also forget because of they're busy. So it's totally up to them. Auto choice, aggressive is also great, and 75% or active choice is also great. Up to you, how do you want to manage it?
And if you're going to do it yourself, then no matter how many switches, there's no tax, right? In terms of changing.
So 4 switches in a year are free.
Okay.
So I don't think beyond that you need to switch out.
You shouldn't be churning so much.
So you shouldn't be churning that much. So there's no cost to switching.
Got it. Okay, so think about how you want your asset allocation mix to be, and the NPS will allow you to invest accordingly. Let's move to a question that we are getting in from Mangesh. I think he's with us on the phone line. Mangesh, hi, welcome to the show. How can we help you?
Hi, good afternoon. My name is Mangesh, and I am an NRI working in the Gulf. While working in India, I had started with my NPS investments, which I continued post attaining the non-residential status. Should I now continue my investments in NPS to build my retirement corpus?
Okay, you're not living in India, but you want to know whether you can continue with the NPS. Got that. And I believe you've also got a second question for us. So just tell us that too.
The second question is through NPS we can have an asset allocation up to 5% into AIFs. Would it be wise to have 5% of the NPS corpus invested into these AIFs? As being a retail investors, there are hardly any avenues to invest directly into the AIFs, while the NPS gives an exposure or provides us with that.
Okay, excellent question. Thank you for bringing that up. Yes, there is a fourth asset class that the NPS does, give exposure to, and that's AIFs, alternate investment funds. Rahul, what do you think of this fourth? Because anyway, I don't think we can go beyond 5%.
Yeah, that's restricted.
Is it recommended? What are the returns like for this particular asset class?
See, personally, I would recommend not to choose alternate investment, though it looks fascinating, but because of the restriction, the way the regulation is drafted, it's pretty risky. Rather than taking that risk in 5%, I would say take that exposure in equity and earn decent returns, because equity has been giving phenomenal returns in NPS. So I would advise not to go for AIF. It doesn't make sense, because what we can do is either REITs, InvITs, or perpetual bonds. Beyond that, you can't do anything.
Okay.
So I would not advise.
Which is pretty much like debt. I mean, sort of quasi-debt.
It is better than debt. It will give you, but the risk is much, much high. Given that we, in terms of REITs and InvITs, are not evolved as a economy much more, would request you to avoid at this point of time.
Got it. Okay, as we are coming down to final thoughts, the most important analysis perhaps, and that is returns, because this is long-term money that we're parking with our pension fund managers. So how are returns performing? Let's pull up the data. And in fact, we'll have some tables come up for you. On the equity side, if you're looking at 5-year returns, and they don't look too bad. In fact, we'll just have those numbers up. Dhirendra, you tell us, when I pulled in some of this data through value research, decent double-digit returns, high-teen returns coming through. How do they compare with mutual funds? And, does it sort of make the cut?
This is very impressive. But, one has to look at the number that you are seeing is of the equity plans. And so if an investor is investing ₹1 lakh, his 75%, the maximum that will go into these plans, which is yielding this much return, will only be 75%. The remaining money will have to be necessarily in the corporate bonds or the government bonds plan. So the number that you see here in case of NPS, that is actually a combination of the 3 plans or at least two of them, and it will be an aggregate of that. But looking at the equity fund performance, I think it is very impressive. And everything else in being equal, the cost advantage is permanent. If there was exactly the same fund managed by a mutual fund with the same actions, it will earn you 1% less.
Okay, a quick comment on returns, whether you're happy with the way the funds have been performing and whether these are sort of sustainable numbers. I looked at 5-year data, I looked at 3-year data. What do you think of the way the industry is performing?
So the returns are phenomenal. If you look at 10-year data also, they are beaten the mutual funds, given that you compare it with apple-to-apple comparison, which is large caps and not small and mid caps. So given that equity over long term, whether it's 3 years, 5 years, or 10 years, NPS has given phenomenal returns, and it's way better than compared to other mutual fund investments within the same category.
Okay, so final take, both of you gentlemen, quick last parting shot on the NPS. What would you say, Rahul? What's your pitch? Why should people go for it?
So NPS is a great tool given the tax advantages and the low cost. It is definitely one of the best tools for retirement planning, but you can always use to create your wealth for the long term.
Dhirendra, quick last 10 seconds, your retirement planning advice.
Don't plan too much. Open account, be at it, and don't look at it. This will be something which will come in very handy at a point. And you can't go wrong with NPS for its cost and design.
All right, gentlemen, thank you very much. I think very valuable advice and lots of important insights that we've picked up on the show today. We promise to do more sessions because, as we said, NPS is a slightly more complex subject, and we'll keep coming back and answering more questions. For now, it's a wrap. Thank you for watching, and see you again next week.
Let's talk money.